Ever looked at a stock, say, Apple, or Amazon, or any company and wondered, what is this business really worth? You might hear investors and finance gurus throw around acronyms to justify a stock price, and one of the most intimidating is WACC. It sounds complex, it looks scary on a spreadsheet, and honestly, it's where a lot of people just tune out. But here's the secret: WACC, or the weighted average cost of capital, isn't just theory. It might be the single most important number for understanding a company's financial health and its true value. My promise to you is that by the end of this 10-minute video, you'll not only understand what WACC is, but why it matters, and exactly how to calculate it, step by step. So, what is WACC? In the simplest terms, WACC is the average interest rate a company pays for all the money it uses to run its business. Think of it this way: a company is like a giant car. To make it go, it needs fuel. That fuel is money, or capital. And that fuel isn't free. A company gets its fuel from two main places. Number 1, debt. This is money it borrows from a bank or by issuing bonds. And just like your car loan, the company has to pay an interest rate on that debt. That's the cost of debt. Number 2, equity. This is money it raises from investors by selling shares of stock. This one is a little trickier. The cost isn't an interest rate, but the return that shareholders expect to get for taking on the risk of owning that stock. That's the cost of equity. WACC just takes those two costs, blends them together, and gives you one single, weighted average percentage. So, if a company's WACC is, say, 9%, that means, on average, it costs them 9 cents for every dollar of fuel they use to operate, whether that dollar came from a bank or a stockholder. Okay, so it's an average cost. Why should you care? This is where it gets really important, both for the company and for you as an investor. First, let's think like a CEO. If you're running the company, WACC is your hurdle rate. Imagine your cost of capital, your WACC, is 9%. Your team comes to you with a great idea for a new factory that's projected to earn a 7% return. Do you build it? No, absolutely not. It would actually destroy value. You'd be borrowing money at 9% to fund a project that only makes you 7%. As a CEO, your primary job is to only invest in projects that earn a return higher than your WACC. That's the only way to grow the company and make shareholders richer. Second, let's think like an investor. This is the big one for us. WACC is the key that unlocks a stock's true value. It's the discount rate used in a discounted cash flow, or DCF, analysis. A DCF model tries to figure out what a company is worth today by estimating all of its future profits and then discounting them back to today's dollars. Why? Because a dollar you might get 10 years from now is worth less than a dollar in your pocket today. WACC is the R in that formula. It's the exact rate you use to discount those future profits. It answers the question, given this company's risk and its cost of money, how much are its future earnings really worth right now? Alright, now for the part that makes most people nervous, the formula. It looks intense, but I promise, we just figured out all the concepts. We're just putting them into math. The formula is WACC equals E divided by V times RE plus D divided by V times RD times 1 minus TC. I know. Looks like alphabet soup. Let's break it down into its 4 simple pieces. First, the weights. E divided by V, this is the weight of equity. E is the market value of equity, just the market cap, stock price times shares outstanding. V is the total value of the company, E plus D. So, this is just asking, what percentage of the company's fuel comes from stock? D divided by V, this is the weight of debt. D is the market value of debt, just find total debt on their balance sheet. This asks, what percentage of the fuel comes from debt? Second, the costs. RE, this is the cost of equity. This is the hardest part, and it's usually calculated with another formula called the Capital Asset Pricing Model, or CAPM. We'll cover that in another video, but for now, just know this number represents the return shareholders demand based on the stock's risk. It's beta. RD, this is the cost of debt. This one is easy. It's just the company's total interest expense divided by its total debt. It's the average interest rate they pay on their loans. And finally, the tax shield. 1 minus TC. TC is just the corporate tax rate. This part is crucial. Interest payments on debt are tax deductible. It's a business expense. So, the government gives you a tax shield that makes debt even cheaper. This formula part calculates the true, after-tax cost of that debt. That's it. You're just taking weight of equity asterisk cost of equity and adding it to weight of debt asterisk after-tax cost of debt. Let's make this real with a simple example. Let's invent TechCorp. We look up their financials and find The market cap, or E, is $800 million. The total debt, or D, is $200 million. First, what's V, total value? EZ. 800 million plus 200 million equals $1 billion. So, our weights are: weight of equity, E divided by V, equals 800 million divided by 1 billion, which is 80%. Weight of debt, D divided by V, equals 200 million divided by 1 billion, which is 20%. Simple enough, right? The company is 80% funded by stock and 20% by debt. Now, we find the costs. Cost of equity. Let's say we did the CAPM calculation and found it's 10%. RD, cost of debt. We look at their interest payments and find they pay an average rate of 6%. TC, tax rate, and the corporate tax rate is 25%. Now, we just plug it all into the formula. WACC equals 80% times 10% plus 20% times 6% times 1 minus 0.25. Let's do the math. The equity part, 0.80 times 0.10 equals 0.08, or 8%. The debt part, 0.20 times 0.06 times 0.75 equals 0.009, or 0.9%. Add them together, 8% plus 0.9% equals 8.9%. Boom! TechCorp's WACC is 8.9%. This means any project they do must earn more than 8.9% to be profitable. And any investor valuing TechCorp should discount its future cash flows by 8.9% per year. Now, I know that was a lot of numbers to pull, especially that cost of equity part. Manually calculating all this for every stock you're researching can be complex and honestly, a bit of a pain. That's why I built a free, easy-to-use WACC calculator on my website, your_website_name, to do it for you in seconds. It'll save you a ton of time. I'll put the link in the description. Before we finish, I want to leave you with 2 pro tips. First, the biggest mistake I see people make is using book value instead of market value for equity. A company's balance sheet might say its book value is $50 million, but its market cap, the stock market value, is $500 million. You must use the market value, $500 million, because that's the true, current cost of its equity. Second, a key insight. You'll notice our after-tax cost of debt was really low. It was 6% times 0.75, which is only 4.5%. This is much cheaper than the 10% cost of equity. This is why you hear the debt is a cheaper source of capital. It's less risky for the lender, they get paid first in a bankruptcy, and it comes with a tax break. So, let's zoom out. What did we learn? 1. WACC is simply the blended, average cost a company pays for all its money, combining both debt and equity. 2. It's the hurdle rate for CEOs making decisions and the discount rate for investors trying to find a stock's true value. 3. And while the formula looks scary, it's just a simple blend of 2 parts, the cost of equity and the after-tax cost of debt. So, your action step is this: the next time you're analyzing a company, don't just look at its revenue or stock price. Try to find its WACC. Or better yet, try plugging the numbers into the calculator on my site, your_website_name. It will completely change how you see that company's value. If this breakdown helped you, please hit that like button and subscribe. I post practical finance videos like this every single week. Thanks for watching, and I'll see you in the next one.